off market is usually what we target and what we go after. Less competition there. We're direct to seller. We might not pay commissions if we found the deal ourselves. Sometimes we have broker networks where we would pay commissions, but they're sending it to their investor community. So getting on those lists and communicating with those brokers and them knowing, having confidence in us that we're going to go out, we're going to close the deal. They're going to be able to, they pass us something and we're going to be able to execute. It goes really a long way that they're going to continue to feed us opportunities because they know we can support the overall acquisition. There's a lot of real estate deals that don't go through based on lack of ability to perform by buyers, I would say.
It's tough for the average person to really be able to source off-market deals because it's one of those things that's like if you're sending out, let's say, postcards, you're not really sending out 100 postcards and getting a deal off that. You never know, you may, but it's one of those things you got to filter through thousands and thousands and thousands of leads and people in order to find a deal that's worthwhile to look at. And it takes multiple leads and deals to look at in order to find one that's worth pursuing. So again, there's oftentimes that on deals that we're closing, it's not something that we just, hey, we just talked to this owner recently and now we're closing on it. It's, hey, no, we spent a lot of money up front to acquire this as a lead, and we've worked at it over the last year or 2 years of follow-up, and now we're finally getting to a closing table with these leads. So it's a business within itself.
Whew. Hey, here we are again. What's up, Mr. Mark?
What's up, Adam?
How are we doing?
Oh, dude, really good. Thank you for asking.
Happy Monday.
Is it Monday?
It could be Sunday, Saturday.
Don't know.
Friday.
Yeah, happy day to you, bud.
Yeah.
What's your plans today?
Well, today, gonna chat with you on camera and then fly home.
Thank God. Yeah, about time.
Yeah.
Thank you.
It's been a good day, exciting day, and our time together is coming to an end.
Can't wait.
Mark gets a little grumpy when he hasn't had a drink yet, so just... So everybody is aware he has not had a cocktail yet, and he's just starting to itch.
Yeah. So I do apologize up front. It is about cocktail time, especially hanging out with this guy. It's pretty much mandatory to drink cocktails to put up with you. If we're gonna have cameras in front of us, we might as well just be honest with
you. Yeah, I would like that. Yeah, I think the crowd would also like you to be honest.
Yeah. So it's time for a cocktail.
So during this episode, if at some point he just starts violently sweating, it is because he has not had a drink.
Yes. Yeah, there may be another video or two out there where I am sweating a little bit for some reason. Yeah.
A little bit.
Yeah. So it's always the check before A and A. Am I good?
Yeah.
But I think I'm looking good now.
You were pouring sweat that day.
Am I looking good now?
You were pouring sweat that day.
Hey.
All right. Well, today we're going to talk about a fund structure versus a syndicate structure.
Yes.
So lead us off, my friend.
Yes, sir. So they're oftentimes confused for the same thing. And to be honest, when we first were looking into fund syndications, we didn't know the difference either.
Yeah, just sort of use the name synonymously.
Yeah. So after many tens of thousands of dollars later and setting up our own fund, we now know the difference between the two, which you would hope so after you spent lots and lots and lots of money on it. But
I don't know if it took us that long to figure it out. I mean, we recognized it by the deal structure. That's why we chose the deal structure.
Yeah, so. but the reason why you would do a syndicate versus a fund, and really what the purpose of, even though we kind of knew up front, now that we set up the fund, you start to really realize, hey, this is really beneficial for this compared to a syndicate. So a syndicate is a legal structure that's set up to be able to raise money from individuals and other businesses, entities, whatnot, for a single deal. So somebody will put somebody, let's say, finds an apartment complex, they're looking to raise money for it. They can pay to have a syndicate formed, and now they're legally raising money to purchase that one asset, compared to a fund can be closed-ended, open-ended, that we can talk a bit more in a minute. But a fund, you're investing money into more or less a company, an individual, and you're not giving them money. Again, it's a structure that's set up, but you're investing in multiple deals. So a fund is going out and raising money and you're investing in the fund, and then that fund will take the money and will go out and find avenues to invest in, like multifamily, self-storage, things like that. So at a very high level, we'll break down some more differences between them, but at a very high level, that's a difference between a fund and a syndicate. So I guess one thing to start off with talking about the differences would be capital requirements between investing in a fund versus investing in a syndicate, if you want to chat about that.
Yeah, and we're going to talk about maybe different scenarios of why you might have a syndicate or a fund. They both have their own scenarios, I would say. We'll communicate why we chose a fund for Cherrypick Capital, for instance. So capital requirements was one of those pieces. So within a syndicate, you pull together some outside investors. It's a single deal. Oftentimes the capital requirements are much higher because it's a single deal that you're going after together. And so each individual needs to contribute a larger amount. With a fund model, usually you can see a lower minimum investment requirement because you oftentimes will have more investors. So more investors, lower capital requirement. And when we were looking at it, for us, why we chose a fund for Cherrypick Capital was the idea that we knew friends, family, we wanted to give them access to the deals, didn't necessarily want to say, hey, we're going to need $50K as minimum investment. We knew people that were going to be maybe on $15K or $20K sort of style, and wanted to allow them access to the deals that we're pursuing as well. So that one was a big one for us, and also communicating with a larger group, allowing us to talk to more investors, get more people involved in the fund, and have a lower barrier of entry. The other piece is asset ownership. So maybe touch on that one.
Yeah, so with a syndicate, you own a part of the entity that's set up to purchase that one property. And again, with a syndicate, you're only pursuing that one property, and that's it. Once you purchase it, then that syndicate is kind of done with. It's still set up while you're managing the property and whatnot, but if you want to go out and pursue another property, you'd have to set up another syndicate for another property. To where a fund, you actually own shares within the fund itself. And again, you can have an open-ended fund where the fund will continue in perpetuity, or you can have a closed-ended fund saying, hey, this fund's going to be around for 7, 8, 10 years, whatever it is. We're going to raise money for the first 2 or 3 years, and then after that, we're going to close off this fund in regards to accepting additional money, and then the fund will continue to operate the assets that it buys, and it will continue to buy assets up until that 7, 8, 9, 10 year mark, whatever that is. So with the fund, there's definitely more ability to have diversified investments, which was another attraction for us. Was, hey, instead of setting up a syndicate and just going after this one asset and having to set up another one and go after this asset, we had investors that wanted to kind of invest in us, and they knew that we could go out, we could find deals, and we could find cash flowing deals and whatnot. So for us with the fund, we were able to pool monies together and been able to purchase apartments with it, self-storage with it, things like that, which helps diversify our portfolio. So if, let's say, multifamily sector takes a bit of a hit for whatever reason, we do have other asset classes of, let's say, self-storage that could potentially help offset that. So that was a major attraction for us when we first set it up.
Yeah, absolutely. So you have that diversification across those different asset classes. We're picking up a self-storage facility now. We have multifamily in the fund today, along with private money lending. So on single family. So you look at that, the diversification across those different asset classes adds a lot of value. And then diversification across different markets as well. So we have multifamily property in a small town called Fort Madison, Iowa. That's done really well for us. Cash flows really well. And now we're picking up self-storage in Council Bluffs, Iowa. And we've done private money lending for single family in Omaha, Nebraska. So kind of all the different asset classes allows you to have more protection, downside protection, along with some upside opportunity as well. So that diversification kind of plays a good role from opportunity for appreciation along with downside protection.
Yeah. And with both a fund and a syndicate, it's often passive investing for somebody to invest in either one of those. You're not the one that's going out there and sourcing the deals, funding the deals, managing the deals. So a big reason for us to set up for us a fund, but could be a syndicate too, was, like I said, we did have a lot of family friends that wanted to get involved in real estate but had full-time jobs. They just liked the appeal of real estate and the potential returns. So with both, they're definitely passive, and people like our investors are looking for guys like us that can go out and be able to source deals. So if you want to chat a little bit about our access to deals compared to maybe what an average individual may come across.
If you're going to go out and try to invest in a property yourself, the first piece is finding the right deal. That sets everything up for a good opportunity and a pleasant experience within real estate. And with that's us doing a lot of due diligence on our end to find the deal, underwrite the deal, and bring it to the table to investors. But that front end, finding the right deal, is not easy to come by. As you can imagine, anything that goes out to the MLS is highly visible, and what might have started as a decent deal when it got listed, there's 10 other people now interested, and price gets run up, right?
Yeah.
And so off market is usually what we target and what we go after. Less competition there. We're direct to seller. We might not pay commissions if we found the deal ourselves. Sometimes we have broker networks where we would pay commissions, but they're sending it to their investor community. So getting on those lists and communicating with those brokers, and them having confidence in us that we're going to go out, we're going to close the deal. They're going to be able to, they pass us something and we're going to be able to execute. It goes really a long way that they're going to continue to feed us opportunities because they know we can support the overall acquisition. There's a lot of real estate deals that don't go through based on lack of ability to perform by buyers, I would say.
Absolutely.
So making sure that it's the right fit there. So that's where that deal flow is super important. You've been able to hire and train cold callers that do direct outreach, so large data sets, calling through those lists to be able to get people to sell their housing.
Yeah, it's a whole business in itself in regards to sourcing the off-market deals.
It is.
And the staff, the callers, the assistants, getting all the data, working all the leads. There's oftentimes leads that we've been working on for 1, 2, 3 years that we just have in our system, and we're doing consistent follow-up with these guys to hit them at the right time when they are ready to sell. But yeah, that whole business, are spending tens of thousands of dollars every month supporting that side of business strictly to access off-market deals. And you can do it on a much lower scale, but unless you're willing to invest the time, the resources to kind of build a team around it, it's tough for the average person to really be able to source off-market deals. Because it's one of those things that's like if you're sending out, let's say, postcards, you're not really sending out 100 postcards and getting a deal off that. You never know, you may, but it's one of those things you got to filter through thousands and thousands and thousands of leads and people in order to find a deal that's worthwhile to look at. And it takes multiple leads and deals to look at in order to find one that's worth pursuing. So again, there's oftentimes that on deals that we're closing, it's not something that we just talked to this owner recently and now we're closing on it. It's, hey, no, we spent a lot of money up front to acquire this as a lead, and we've worked at it over the last year, 2 years of follow-up, and now we're finally getting to a closing table with these leads. So it's a business within itself.
It is, yeah, absolutely. That deal flow is critical. Again, finding the right deal. You're going to be in a vastly different position if you get it right from the start.
Yeah.
You can always try to optimize once you have it. You might be able to drive down expenses, increase rents, but getting it at the right price is really critical at the front end.
Yeah, and this kind of leads into another bullet point I want to bring up, was difference between like an active and passive investor.
A lot of people within the fund today are full-time employees, W-2 workers. make their money and focus their energy and time and resources toward that career, that employment, and don't want to invest in real estate, don't have the time, don't have the knowledge necessarily to go after those deals themselves, or maybe even the capacity. So one of the benefits as well that you can pool in money is you can go after bigger deals and run effectively those larger projects. So as a passive investor, you end up investing your money, getting the returns, but you're not bogged down by the intricacies of day-to-day operation of a real estate fund. Whereas an active investor, it's the flip, as you can imagine, right? You're going out, you're finding the deals, you're managing the deals, you're managing the people to manage the property. There's a lot there, and that's awesome if that's the route that you want to go. I mean, obviously we are active real estate investors, and we would be the first people to help anybody in the space. But also recognize that it's not for everybody. It's a passive investment is a great opportunity to be able to invest in real estate, get access to deals, yet not be absorbed by each and every piece of that business.
Yeah, we have a handful of investors in our fund that were active investors at one point and realized, hey, active investing's not for me for whatever rhyme or reason, and decided to sell off some of their assets. Like one investor ended up buying a handful of properties from him. We structured it with owner financing, so he was still making a return off those properties after I bought them because he financed them for me. And they started seeing, hey, I love this passive income. And then he was one of the first ones on board once we formed the fund to invest more money.
Yeah.
And another buddy that same thing, same scenario kind of as you, where he was out of state. He bought a few houses from me in Omaha, got them managed by a management company. Things were going well, management company's management, but oftentimes, like you made a mention a second ago, you got to manage those management companies as well. And he was just getting frustrated with how the management company was handling some things. Sometimes when you're investing as a side business, let's say, instead of having it be a full-time business, sometimes things can be a little bit more personal to you. So for him, when tenants would go in and they'd move out and they'd leave a property a complete mess, he got bummed out about it. Like, he affected him a lot more than what it affects me, and it really started to get to him to where it just wasn't attractive anymore. Even though he was making a decent return off it, he was getting some of the benefits of being an active investor. It wasn't for him. So he ended up selling off the couple properties that he owned, and now is investing with us passively and loves it. He still gets a similar return, oftentimes maybe a little bit higher than what he was getting now or before. And now he doesn't do anything besides gives us money and then gets a check every quarter.
Yeah, and that's when you're looking on paper and like, oh, I'm just going to go out and invest in my own real estate, and then I kind of have control and whatever the rationale is that you went out and was an active investor for real estate, but then all of a sudden realize that sometimes it doesn't go out as planned, and you end up not making the returns that you had expected. You're not operating it as, let's say, the most efficient business sometimes, based on your contractors might be a little higher priced than what we're getting because we're doing things at volume. The price of labor, the price of materials, the renovations, the overall strategy of the renovation, all of that might be a higher cost for somebody doing it by themselves, or has one property or two properties in comparison to us and what we're operating. And then the last piece is diversification. And if all of a sudden your furnace goes out, your AC goes out, in my property when I bought from you, the tree fell like 3 months in that ripped up my driveway, and that ate up my income, my profit for a year.
Yeah,
it was like $3,000, and I was cash flowing at like 300 a month sort of thing. So almost a whole year. Whereas if you have other properties to offset some of those things, it's not as drastic of an impact to you. And then on top of that, the bigger things that you can go after with a fund or a syndicate, you have oftentimes tied into that property already some level of diversification. You're going after a bigger building. It's a multifamily facility. One unit goes down, you have another 50. You have another 100, whatever the size is of that. Same thing, self-storage. Hey, I haven't rented one of the units. Well, you have 99 others.
Yeah.
So that's an important piece as well to consider when you're thinking about active versus passive investing. What are the true returns that I can achieve through my own active investment? What is my true goal and aspiration? Am I investing in real estate because I think it's cool and sexy? And I want to buy a house. Awesome, great. Or am I just trying to get a return? I want to focus my time and energy with the family, with my current employer, with other areas to go drive revenue that you can go invest in real estate and hopefully take that money and go retire early or whatever the heck you want to do with it, right? Get your time back.
For sure, yeah. That's a big one.
So having that opportunity of syndicate and fund model allows you to go buy bigger things, and there's some value there for sure.
Yeah.
What are some of the key takeaways or any additional points that you're thinking about as far as syndicate versus fund?
I would say just looking or knowing that you can passively invest in real estate. When I first got started in real estate, I thought when you were in real estate investments, you were the one that was buying the properties, being an active investor, doing all that stuff. I didn't know there's opportunities to where, hey, I could just take this money and give it to a fund or invest it into a fund or syndicate and sit back and, in theory, collect paychecks on it. So having conversations with more and more people, you start to realize, hey, these guys don't know that there's an opportunity to invest passively. They think it's all hands-on and completely different than what you do when you're investing in a fund or syndicate. So I would say that that's one thing that really stands out to me is if you're looking to get into real estate, to explore both being an active investor and what that looks like and entails, but then also, hey, how does that compare to just me investing passively into a fund or a syndicate?
Yeah. And that comparison of somebody running the business as a full-time job and career.
Yeah.
In comparison to real estate investing as, I'll call it a hobby. Maybe somebody may not like that terminology, but right, it's like, in the background and kind of more of a hobby versus full-time job.
Yeah.
And within any type of business, real estate's no different of how do you squeeze out the most out of a business, and it's time, energy, focus, and execution. And with that, you want somebody that's on the ground, in the weeds, squeezing out all that can be within that property, all the profitability within that property. And that comes from operational expenses, comes from finding the right deals. It comes from driving rents, understanding the market rents. It comes from tax benefits, depreciation, and doing things that we're doing around like cost segregation studies.
Yeah.
When I was starting out in real estate, I knew nothing about that. And I think there's still a lot of people within real estate that don't know cost segregation study. Yeah. And on a smaller facility, it may not make sense for just a single active investor, but on the bigger stuff that we're pursuing, it is a game changer.
Huge, yeah.
It allows our investors to be able to write down taxes, decrease their tax impact.
We have some investors that strictly invest in the fund for that benefit of the depreciation that we can offer.
Absolutely, yeah. So you start to see some big impact from a tax perspective and an overall return on your money by looking at a fund or syndicate model and having somebody that's operating it at their true capacity versus, let's say, again, kind of doing real estate as a hobby.
Yeah.
And not trying to deter anybody one way or the other, trying to just bring light at the fact that
there's options.
There's options, and it's not as always sort of cut and dry, like, oh, well, I could just go do it myself. You can, but just consider what you're signing up for from a time impact, what you could be doing with that time and energy and potentially making more money in your day job, for instance.
Yeah.
And pushing that back to real estate and growing the portfolio that way in a passive way.
Yeah, I think that's one thing people don't take into consideration is their amount of time doing stuff. And I think people undervalue their time pretty considerably.
Sure.
So sometimes at the end of the day, you're putting in all this time, sweat, and tears into this property, thinking that, hey, I'm kind of ahead of the game because I did all that stuff on my own. Where in reality, all that time that you put in, like you mentioned earlier, maybe that time could have been put more towards something else that would have benefited you a little bit more, and instead just invested passively and still see the same returns, just took a fraction of the time to see those same returns.
Yeah, exactly. Somebody that's focused on generating the largest profit, but also the least amount of risk.
Yeah.
Largest amount of downside protection. So those are the big takeaways for me, and always interesting to look at the models between fund and syndicate, and where it might make sense to roll in fund versus syndicate. For us, as we had talked about, just big benefits around having the structure set up. People can continue to invest. We can continue to go buy assets. We don't have to sort of go through the additional legal route every single time that we're buying new properties. We're just rolling it into the same fund and giving investor access and diversification and risk tolerance.
Cool.
Awesome, brother.
Sounds good. You did good, bud.
Appreciate it.
Good job.